calculate the stock price for Dave and Buster's. I actually did the a video for this company about a week ago, but I have recently revised my model quite a bit. I took into account a lot of factors such as debt, such as market cap. Also, if there's a lot of like big drops and big increases in the numbers, it kind of smooth things out to try to make my model more efficient and robust. And I think it's a lot better because the more recent companies I've been doing, the numbers have been coming a lot closer to what they're actually trading at, which doesn't necessarily mean the model is correct, but I think that's a good indicator. So let's get started. We need the market cap 630.7 million. And the stock price is 13.31. So the shares outstanding is the market cap divided by stock price. That's the shares outstanding, 47 million. So we need that because what we're going to do in this video is we're going to calculate the future free cash flows of this company. That's how you calculate the intrinsic value. You estimate the future free cash flows, then you discount those dollar amounts back to today's dollars, and then you take that value, which is the value of the company, and you divide it by the shares outstanding, and that gives you the intrinsic stock price. And we're going to compare it to the actual stock price to see if it's a good buy or it's not a good buy. Now let's get the free cash flows. We'll go to Yahoo in a financial section under cash flows. And this is the best way to value a company, is the free cash flows or actual cash that has come in and out of the business after operations. Net income is what we also need in the model, and that's profit and loss. And we don't use net income for models, for forecasting purposes, is because there's a lot of non-cash items, and they use accrual accounting, so it can be really tricky to forecast net income. It's not as good as an indicator as free cash flow. And last is revenue. That's actual sales in a given calendar year. So you can see free cash flow is pretty consistent, although there was a big jump in 2018. There could have been some big cash expenses in 2016, 17, 19, but we could find that out in 10K. Net income has grown pretty consistently, although it seems to drop off a little. And revenue is usually the smoothest number. That has gone up pretty consistently year to year. So far the numbers look pretty good. Nothing stands out too much. So the model should be able to use these numbers pretty easily. Now we need to look at the capital structure of Dave & Buster's to figure out the discount rate we need to apply to future cash flows. And the interest they pay on their debt is 20.2 million. Let's see how much debt they have. We'll go to the balance sheet for that, go to the liabilities section. And the current debt is 15 million. That's debt due within 12 months. The long-term debt is 630 billion. That's due after 12 months. So they pay 3.13% on the debt. Now, since interest payments are tax deductible, let's find out the effective tax rate. So we'll go back to the income statement, and that's income before tax is 127 million, and the income tax is 27 million. They pay 21% taxes. So the cost of debt is 2.5%, and half of that capital structure is debt. That's why my new revised model would take this into account and give a haircut based on how much debt a company has. So let's see the cost of equity. We need the beta for that. And the beta is 1.61. That means it moves about 1.5 times the market, the stock price. So you can see that cost of equity is higher than the cost of debt because equity tends to be more riskier because it sits lower on the capital structure of a company. So in the event of a default, debt holders are paid prior to equity holders. And equity holders tend to get nothing, maybe 1 or 2 cents on the dollar. And now to calculate the WACC, the weighted average cost of capital, we just combine the debt and the equity. And then we get 8.49%. And that's the discount rate we're going to use on the future free cash flows. So we estimated 4 years of free cash flow, Then the terminal value, or all years beyond year 4, we discounted those numbers back to today, and we get a value of $800 million for the company. We divide that by 47 million shares, we get an intrinsic stock price of $17. And it's trading at a little over $13. So it's trading at a 22% discount. And it looks like it was trading way higher a few months ago in the 50s, over 60. So the reason a stock may trade higher or lower than intrinsic value is because people think the future of the company doesn't warrant the actual stock price. They may think Dave & Buster's may struggle this year and next because coronavirus may affect their business. Less people want to come in and play games, which is probably true. Now you need to decide that as an analyst yourself. Is this a good investment? Will they get through coronavirus? Will sales drop or pick back up shortly next year? That remains to be seen. But thanks for watching the video, and let me know if you want me to do any other companies. Have a good